2022 was a year of disasters. Historically high inflation, falling stock market, 2 quarters of decreasing GDP, war in Ukraine, elections, layoffs in the leading Bay Area companies, growing interest rates, and it ended with multiple floods in the Bay Area right before the new year. What a year! 2020 definitely feels like 2022. From the real estate point of view, 2022 was a tale of two markets. First half of the year was continuation of the exuberant 2021 market. The prices continued growing, and the number of new listings and the number of home sales stayed high. By April, home prices in the Bay Area jumped by 16.5% year over year. The local homeowners felt euphoric. The equity in their homes reached all-time high. But then the real estate dream market started deteriorating rather quickly. It all started with rising inflation rates that had some kind of a domino effect. In June, inflation peaked at 9.1%, and that is when Fed started to jack up rates. The first 75 basis point increase was announced at the June meeting, followed by more 75 basis points hikes in July, September, and November. Feds ended the year with a 50 basis points rate increase in December. The mortgage interest rates reacted to the runaway inflation and Fed rate increases. Based on the Freddie Mac weekly mortgage rate survey, the interest rates more than doubled from 3.2% at the beginning of 2022 to almost 7.1% at the end of October, before sliding down to 6.4% by the end of the year. August interest rate increases finally shifted the entire Bay Area housing market. The number of sales quickly declined, and all spring price gains got wiped out. By the end of the year, in December, prices declined by 9.2% compared to December of 2021, and the number of sales was cut in half. Sellers stopped selling and the buyers stopped buying. In 2022, we observed one of the largest home sale prices swings in 1 year. From January till peak in April, home prices grew by 13.7% and then dropped by 20.1% by the end of December, all in a 12-month span. In the second half of 2022, we were witnessing a down spiral of the market. Of course, all sensation-seeking media outlets started predicting a doomsday for the real estate market. Well, as it often happens, they were wrong. Market definitely slowed down, but not even close to the crash they were selling us. Looking at 2022 as a whole year, the median home sale price in the Bay Area still grew by 6% compared with 2021. Because the number of home sales in 2022 declined by 28.5%, some analysts interpreted it as the beginning of the housing market crash. What they missed was that in 2021, after COVID restrictions got lifted, the number of home sales jumped by more than 30%. If you would average the number of sales in 2020 through 2022, they will fall nicely within the long-term Bay Area housing market trends. No drama here. These simple facts explain the situation. Keep in mind that the big picture of the Bay Area real estate market that we're discussing here is not 100% applicable to every city and every neighborhood. Some neighborhood markets happen to be more resilient and stay strong, and others give more into the economic and geopolitical troubles. If you are a homeowner and want to understand your neighborhood market and learn how well your own house keeps its value, call or text us. We will give you a full update. My contact information is in the description of this video. And if you are a home buyer looking to take advantage of the current market to find great deals, talk to us. We'll help you navigate this challenging market. What should we expect in the near future in 2023? Here are 3 main factors that will shape the housing market this year. First, and the most significant challenge now, is the interest rates. They greatly affect home affordability. Lawrence Yun, chief economist of the National Association of Realtors, predicts that after big swings in 2022, This year, the rates will settle at 5.7% for the 30-year fixed-rate mortgage, which will provide much-needed certainty and stability to the housing market. Second is the housing supply. We expect the supply of homes to remain restricted. In recent years, many homeowners were able to refinance their homes at historically low rates. If they want to move, they will have to finance their new homes at significantly higher rates than their current mortgages. This will provide a strong disincentive for them against selling their current homes. Many people will keep living in smaller homes or accept longer commutes in exchange for keeping their housing costs down. This will keep the number of homes available for sale down. Combined with the almost no new construction in the Bay Area, it will create a severe shortage of inventory, even more severe than in previous years. And finally, third is the demand. We expect that the demand for housing will remain strong. It will be driven by new household formations by the millennials, who are in their prime home buying age now. Millennials are currently the largest generational group, making 27.5% of the US population. They are a significantly larger group than the current retiree segment that contributes the most to the existing home sales. Because of this, the demand will outpace supply in the foreseeable future. Based on these three factors, we don't expect any large price movements in the housing market. We may see slight price increases or small declines on an ever-shrinking number of sales. With all that being said, real estate may prove to be an island of stability, especially if the economy will go into a recession. So, if you are thinking about buying or selling a home within a year or even two, let's discuss what would be the best time and destination for your next move. Call or text us at 650-766-6100. We're always available to answer your questions.